Hey Dion, welcome to the DeFi Drop today. And I'll just give you a quick intro to our viewers. So, Dion Chu is CEO of Term. Term is a DeFi protocol offering fixed rate lending via on chain auctions. So, Dion, welcome. I'm going to dive straight in. I'm a user of Term. I'm in one of the vaults at the moment, curated by Clearstar, I think it is. And I've been looking forward to this show. So I just want to dive in. One of the benefits of Term is that borrowers never pay above their specified maximum borrowing rate, all right? And lenders never lend below their specified lending rate. How does that actually work?
Yeah, and I think that's actually, there's two questions embedded in there. But, first, thank you for having us on. I'm really excited to be here and, love the opportunity always to be able to share more about Term with the various communities. But yeah, in terms of answering your question, Term is a fixed rate lending protocol. In many senses, it's just like Aave. Loans are over collateralized by ERC20 tokens. The value of collateral is monitored by oracles on chain, like Chainlink. And if the value of the collateral falls below a certain threshold, the collateral gets liquidated to protect the lenders from bad debt or defaults. Term operates the same way. The only difference is it has fixed rates for a fixed period of time. And the way that's enforced is, say, a borrower fails to come back at loan maturity to repay the loan. Because Term has a collateral, the collateral will be liquidated to ensure that lenders receive their liquidity back on time with interest paid in full.
Yeah, it kind of takes the edge off, right? Especially for new users as well. And it's very simplistic terms just laid out in front of you. But so it's clearly a unique spin on lending with fixed term loans. Why did you guys actually decide to build around this model instead of the floating rate approach that dominates DeFi?
Yeah, a lot of this came from, my time I served for a brief period as a DAO treasury manager, managing short-term liquidity for the DAO. And at the time, all the lending protocols were variable rate. And as we in DeFi know, variable rates in DeFi are very different than TradFi. In TradFi, the Federal Reserve controls the short-term rate. They move very deliberately and very slowly, and everything is telegraphed well in advance. In DeFi, rates are completely open to the free market, and what we've seen is that they can fluctuate quite widely. In any given month, the rate for the following month could be plus minus 3, 4, 5%. And in cases where there's a liquidity squeeze and utilization exceeds the, kink, you'll see interest rates spike upwards of 60% multiple times a day, as the market's trying to rebalance itself. So as a lender, it's very hard to have any certainty as to what I'm going to earn over the next month.
Hmm.
And as a borrower, it's much worse because you could end up be paying 60% for a few days, having no control over your position. And particularly for DeFi yield farmers looking to earn kind of an arbitrage spread, that completely, throws that trade underwater. Um, so that's kind of the motivation, right? Personally, I come from a background as a fixed income trader. In TradFi, fixed income is one of the largest financial markets globally. And even for short-term secured lending, where there's a significant amount of overnight kind of variable rate borrowing and lending, even in that market, about 60% is term lending. So anywhere from 4 weeks to 3 months, particularly in European markets where it's more popular. So it's a huge market, to be able to go after, huge addressable market. It's just a question of, trying to build it out.
That's great. So it's actually ingrained in your DNA. You've been doing it for a while. So yeah,
Yeah, that's
nice spin on it. Yeah, and on that TradFi note, okay, right now you've got a TVL of around 40 mil, I think, which is epic, and adoption's been great. Excuse me if I'm wrong on that. It may have changed today. But what on the TradFi side, how much of a shift, or if you can track it, are you seeing coming over from TradFi? Which types of users are finding like most value in your model, so to speak?
Yeah, so right now what we see is a lot of the institutional DeFi users, there's very strong demand on the borrow side. A lot of these players are borrowing on Aave or they're borrowing on Morpho. And what you find there is, a lot of people are doing, we call carry trades. And DeFi, I call it looping. Essentially, if you have an asset that generates 10% yield and you can borrow at 8%, there's a 2% spread. And if you can leverage that, 5, 7, 8x, then you can generate, healthy returns in excess of 20 or 30% return on capital. That only works if the borrow cost is relatively stable. And a lot of times, what you're starting to see within the variable rate lending protocols is a game of cat and mouse. And the borrowers come in, they borrow, the rate looks low, then the carriers pull liquidity, the rate goes up, they have to repay, and it's kind of, they say, oh no, don't worry, we're going to put more liquidity, the rate will be stable. They come back in, rate goes up again. So they're constantly playing this game, and there's no way to really have any certainty or be able to sleep at night running these carry trades, especially when the spread is pretty skinny.
Right,
Um,
right.
so when they're able to do that on term, lock in a spread, it's very popular to lock in fixed rate borrow to maturity, matching the maturity of a PT token. You know exactly ex ante what your profit's going to be. And you can walk away from the trade and not have to ever think about it again. So borrow
That's
demand,
me. That's literally me.
exactly. That's what term is able to offer. It's pretty
Yeah,
unique right now in the space. Um,
it's super unique. Yeah, and you guys also launched the staking and governance in April. So some time now, but I must take my hat off. Amazing design. It doesn't just earn rewards, right? But it safeguards the protocol itself, as you guys say, literally in your own words. But can you explain a bit about the genius behind this design?
Yeah, I think for us, it's really to establish a link between the fundamentals of the protocol and the value of the token in the long run. So, this mechanism, we actually forked the Unistaker contract. For a period, Uniswap was going to follow this model. I think for various reasons, they ended up moving away from it. But we think it's still a good model to follow. So the way it works is that stakers, and over the long run, as we grow and there are excess protocol fees that we want to distribute to the token holders, it gets distributed through this contract in the form of USDC, so real yield, and it gets distributed over a 30-day unlock period. So anybody who comes in during that period gets their pro rata share of, that distribution. Early days, it's not going to be very large distributions. We find the capital is better used, reinvested into the protocol itself. But the goal is kind of once you hit a certain tipping point, that would be the best mechanism of distributing to the end token holder. I think something else that's, key to that is you see a lot of protocols with long lock periods, 4 years, 2 years,
Yeah,
1 year. But that makes it very difficult for funds who have, let's say, monthly redemption windows to be able to invest in those types of tokens because it just doesn't fit their liquidity requirements. So there is no strict unlock period. It's, pretty much, deposit and unstake at any time.
that's great. It's it's what I look for. I'm not gonna lie. Um, okay, the lock periods do sometimes have their benefit as well. I mean, you just lock them, and you can't touch those. You can't touch that for a while. But I way prefer this. It gives the flexibility, the peace of mind, like you say. So, but you also mentioned auctions, right, for matching borrowers and lenders. Can you explain a bit about these auctions, please, and why they create this efficiency?
Yeah, so, the auction model we actually borrowed from, US government bond auctions. In fact, all the G7 countries issue government bonds in the first instance through an auction model. So the auction design, the technical term is a second price sealed bid auction. It's a sealed bid, meaning these are blind auctions where the participants don't see the rates that all the other participants are submitting. That's very important because say you told me you're willing to lend at 2%. If I know that, I'm never going to say I'm willing to pay anything more than 2 because I know I can get filled with you at 2, so you're giving up information. And in these games, people start kind of playing around, they start shading the rates, and it's very hard to find like the true market equilibrium. By making everything blind, there's no downside to posting the true rate, the true bottom line for you. You still retain the optionality of potentially lending or borrowing at a better rate than you submit because the information is private and it's hidden. So that's a key feature of these sealed bid or blind auctions. And it's a single price auction, meaning there's no price discrimination. So anybody who participates, both on the bar or lend side, if they are filled, get filled at the exact same level. So again, that's really important to ensuring that nobody feels like, there's any need to hide or bid or offer a rate anything other than their true best, best rate. We have an earn page as well. So what the earn page is, sometimes lenders who receive an allocation in an auction, they'll turn around. There's a secondary market on the listing page, the earn page. So if you don't have time to monitor these auctions, you can't show up by a certain time, no problem. Go to the earn page. You can see what's available and you can just go and with a single click, you know, enter into any of those loans that are available. Yeah, the strategy vaults is the third product. So that's kind of like a fully automated kind of portfolio.
Yeah.
So it'll roll everything for you on an ongoing basis. That's like the most passive. The earn page is more like you still have to kind of monitor. It allows you more flexibility in terms of managing exactly your liquidity profile. But yeah, you'll have to go pick specific loans. So it's kind of more for an intermediate type of user who wants a little bit more control, who's willing to do a little bit more work.
Nice. All right. And also, partnerships, right? So you've got a ton of curators on there, external risk curators, and they influence the design of terms, vaults, and strategies. Because you've got a few, right? You've got RE7, ClearStar, which I'm in, Shorewoods, K3, quite a few. Yeah. So question would be, are there any governance checks for their proposals?
Yeah. So all of the vaults go through standard Aragon DAO governance. In order to participate as an LP, you would have to wrap your LP token to make it compatible with the Aragon DAO structure. But anybody who has a DAO token is able to veto any parameter changes to the vault. So the vaults specify everything from collateral whitelist, so what tokens the vault is willing to lend against, as well as minimum collateral ratios for each of those whitelisted collateral types. There are also controls over reserve ratios. So what percentage of the vault must remain liquid to help facilitate redemptions, and concentration ratios. So, trying to promote diversification within the vault across various types of loans. So all these parameters are managed by the curator, but any change will go through a 7-day time lock for the most part. It will show
Okay.
up on the UI. There is a governance tab within the vault section for you to view any pending changes. And as an LP who has a wrap token, you'll be able to go in there and veto that if you don't like the change or you find that it doesn't really align with your interests.
Okay. Thanks for the heads up. And in terms of vault architecture, what was the reason behind choosing Yearn v3 smart contracts? I was checking your documentation actually before I was putting this together, and yeah, so I got a bit of an idea, but I'd love to know a bit more behind that decision.
Yeah, so when we saw the trend was everybody's doing 4626 vaults. That's sort of the standard implementation, the convention that everybody's settled on. So we knew that we wanted our vault to be a 4626. And there was a decision. We could either build the whole thing from scratch. The hardest part about the 4626 is really the accounting. There's a whole bunch of code that needs to be designed, implemented in terms of managing accounting, making sure that you address all of the edge cases and potential exploits that have been discovered in the past. And we could have done that ourselves, but we also saw that Yearn, they've been in this game for a very long time. they had the Yearn v3 coming out. It wasn't public at the time, but it kind of got a preview of what they had already built there. And it just made sense to really let the experts handle the accounting side and let us, the protocol, focus on how to integrate our protocol within a standardized 4626 vault. So it ended up being a great partnership with Yearn. We know they have a very robust 4626 vault that they've built, be very generic. And all we had to do was focus on integrating that generic vault into the term ecosystem. And it gave us a lot more speed and allowed us to move forward with this vault a lot quicker than if we had to build everything from scratch.
Yeah, it's smart, like why reinvent the wheel? So looking ahead, what new features or markets are you most excited to bring to Term users?
Yeah, so we're starting to work on our V2. One of the things that we notice is that you know DeFi UX UI really sucks. Everything you have to do and approve, you have to do a submit. There's two transactions, especially if you're using multi-sig, that quadruples the amount of time it takes to do a single transaction. Um, and as DeFi, DeFi is meant to be, they call money Legos, right? You're supposed to be able to do maybe pull something from Aave, lend it on term, or vice versa. Maybe you want to do a flash loan, repay. All of these kind of batch transactions is very difficult to do. It takes a long time. Something that should take 2 seconds takes you 30 minutes or an hour. So we're going to be building out a router. It's optional. People want to go through the standard slow but secure path. That option is still open to them. But for people who focus more on efficiency, we will have a router that will allow people to batch any number of transactions, both within term itself, but also, certain protocols that we integrate that are commonly used in conjunction with term. So we hope with that, a lot of these things that are taking our users, maybe an hour to do, can now be done within a single click. And it'll be, super flexible. Any function that we've implemented through this diamond pattern will be able to be batch, mix and match with this new router system. So I think that's going to be a big one for us. Another request that we've gotten a lot from our users is the ability to loop within, a single click. Again, if you were to loop manually, you spend an hour. Can we loop with a single click? That's what this new router is going to help allow, enable. So keep an eye out for that. There's also some like other new interesting twists and products that we're going to be rolling out that build on, the foundation of the fixed rate loans that we've created in our V1. Um, not much to say about that currently, but would love to come back and talk about it, when that's announced.
So yeah, thanks very much for your explanation, Dion. I'll just like to say as well, like on the Portals Explorer, you'll be able to find all your term positions there. We have the Portals Explorer app, which allows users to make DeFi executions in literally in one click. So yeah, have a take a look at it. It's pretty handy. It's pretty
Yeah,
handy. So yeah, I think we have about 25 to 40 term positions up there.
yeah, very cool to see that.
Cool. All right. Well, Dion, the last question, and this is a question we always end with. Today, the total TVL of DeFi, as per DeFi Llama, is $158 billion. What's your prediction for this number at midnight on the 31st of December 2025? So that's New Year's Eve this year.
Yeah, if you look at DeFi TVL, a portion of it is just the value of ETH. A lot of ETH holders on Ethereum mainnet, for obvious reasons. And I'm pretty bullish on the outlook. I think the market will be higher by the end of the year. So, I think a safe conservative estimate would be 200 billion.
That is epic. Like it. You're going in the charts, and if you win an amazing amount of cool points.
Awesome. Excited for that.
All right, we'll share the chart soon. Look, Dion, I know you're super busy. Thank you so much for jumping on and sharing all your insights about term, and I hope this is going to be really useful for everyone out there. In fact, it will.
Yeah, no, really appreciate you guys having us on. Excited to be able to speak to your community and look forward to maybe coming back in the future.